Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, when it comes to financial decisions, a lot of them are influenced, shall we say, by what other people do. What is your neighbor investing in? What is your best friend investing in? And when you meet somebody at a dinner party, for example, and they say, hey, what are you doing with your mutual fund investments? You should be investing in scheme A, B, and C. And invariably, those schemes are sectoral or thematic schemes that have done particularly well over the last 6 months. And you feel, what have you done? Why have you made the decisions that you've made? Well, we're here to tell you that you're not really in a very small minority. In fact, most people get their decisions wrong when it comes to investing in sectoral and thematic funds. And we'll talk about why that is. We'll also talk about how you should approach your investments into these schemes. Joining me today is Himanshu Kohli, the co-founder of Client Associates. Himanshu, thanks so much for joining me and for speaking to me about this very interesting topic. Now, I did send you a few questions in the run-up to this conversation, and the data that you've pulled up is quite eye-opening. In this entire realm of nearly 200 schemes, it turns out that not many of them have been able to beat their respective benchmark and the wider benchmark either.
Right, Alex. So I would say what you mentioned, it's a typical social conversation. Someone says, I have invested in a defense fund. It has done phenomenally well. I have invested in ABC fund. It has done very well. And next day you want to pick up your paper and just maybe invest over there. So you're chasing maybe certain themes, certain excitement which is happening. And I would say the simpler you keep it, the boring you keep it, it is better for you from a long-term point of view. So if you see the data, very few funds have actually beaten the respective benchmarks. Very few funds, active category, have been able to beat the broader category, which is BSE 500 as a benchmark. Now, we do not think it's the best thing for investors to just chase certain themes basis what their neighbor has told them or their friend has told them, or maybe what they have seen some excitement on some one of the news channels. It is very important to put your whole investment thesis into an investment policy statement. How much should be the core portfolio? How much should be the satellite portfolio? And if satellite portfolio is offering you one or two themes which you can just top up, what should be the best approach to go for it? Should it be through a pure passive index or should it be through an active manager over there? It's extremely important over there.
It's an important point that you raise. And what we'll do is we'll delve into some of the details. I think, Himanshu, the tendency also is to look at fund selection like you would look at an equity portfolio. And here, I think a lot of people, and this is data that proves it, most people venture into equity mutual fund schemes. And I know that that trend is shifting, thankfully so. People are looking at fixed income, people are looking at hybrid as well, which is a good sign. But the reality is that most investment takes place, retail investment takes place in the equity space. And people do select this basis how they would normally select a stock portfolio. Do you think that's the reason why you have a problem? And the fact is that we don't have a lot of history, a lot of expertise when it comes to selecting investments.
Right. So I would say a lot of people, they are chasing returns, chasing performances. In fact, the more detached you are with the portfolio, the better the performance is. So if you see from 1st of Jan till 15th of May, 4.5 months, there are 196 thematic funds which are there in the system. Only 14 of them have been able to outperform their respective index and the broader markets. Only 25% of them have been able to perform their respective index. Now, it is better to go to diversified mutual funds, or maybe if you want to add certain themes in your portfolio, it is better to go maybe through the index strategies. That is something which I would say is a better way to manage it. In fact, some of these hybrid funds, a lot of people said asset allocation should be in your hand. Why are you giving the discretion to the fund manager? In fact, if you see the data 3 years rolling, 5 years rolling, some of these asset allocation funds or balanced advantage funds or balanced funds they have actually done far better because investors are detached from the investment decisions. There are no inefficiencies which comes into picture over there. And if they are particularly bullish, those fund managers are particularly bullish on certain themes, let's say banking, financial services, or defense per se, they can always overweight in a diversified fund towards those themes and give you that alpha creation if it's possible.
And the data that you've shared in the sectoral and thematic category, I just want to pull that up on the screen while we're at it, just to drive home the point before we go to Himanshu and ask him what he is advising at this stage and what he's seeing basis the trends that are currently prevailing. In the automotive space, for example, there is only one fund and it hasn't beaten the benchmark. PFSI, much more populated, but none have beaten the respective benchmark. Both benchmarks also not beaten. Consumption, there's one fund out of 18 that has managed to beat both the benchmarks. You have the most outperformance in the tech space, where you've seen 4 that have managed to beat their respective benchmarks, but they've not really managed to beat the broader market benchmark, which is the BSE 500 in this case. So it's not really looking like a pretty picture. But having said that, Himanshu, it's not like you don't recommend investing in sectoral thematic. You pointed out that there can be a tactical allocation. So if one is to look at this juncture, what the landscape looks like, how does it look like to you?
So, Alex, we always believe in a core and satellite strategy. Core is 80% of the client's portfolio, which can be across large flexi oblique multi-cap, oblique mid and small cap, diversified funds, oblique certain indexes. Then there is a satellite. So let's say there is a theme which, let's say, banking and financial services is looking very good. So about a year back, 9 months back, we gave a call that we would like to add 10% over there. Now, there one can pick up one of these active managers or just the pure index over there and build the portfolio around it, because let's say if interest rates comes down or maybe the sector has not done very well in the past and today is available at a reasonable valuation, some of those things really bring alpha in clients' decisions. So this core and satellite approach really helps us. And sometimes we do not have anything in satellite, then maybe the 100% portfolio could be a core portfolio also.
Okay. I want to talk about some of these aspects, because you've shared certain data. I was looking at the top performance and the bottom performance over the last 1 year for the sectoral thematic categories, and I was looking at some of the more popular themes and sectors, right? So things like IT or tech, and things like infrastructure. And I found, Himanshu, that there is a very wide variance in the top performer and in the bottom performer. In certain cases, there is negative returns as well, whereas the top performer is gaining about 20% or 18% or thereabouts. Why is that? And talk about the way that these funds are curated and the portfolios are made.
Right. So let's say if we see some of the top performing themes have been defense, which has given about 28% returns in this year. I think a lot of it has happened because of this uh, latest India-Pakistan tension. Defense stocks have done fairly well over here. But at the same point in time, they have become expensive. Now, financial services, as a broader theme, has done fairly well. It is also an outperformer right now because of the interest rates being low, the margins have been maintained, all those things. And it was not a top performing sector maybe 3 years before this. So this has actually come up quite well. And if you see some of these sectors which have not done very well is, let's say, pharma, for example, or IT, for example. A lot of it is dependent upon US also. Maybe there is some discretionary cut which is happening over there. So some of these things have actually not done very well. So if broader market, which is BSE 500, has given 2.5% returns, the range of certain themes could be anywhere between 28%, which is for defense, and minus 11, 12% for IT, which has actually happened over here. So I would say uh, these themes, they bring so much of excitement to people that I want to chase a particular theme because I've heard there is some major thing which is happening because of Mission Sindoor, uh, or something is happening in the technology side. For a retail investor, it's better to just stick to more diversified funds, even to maybe broader uh, uh, asset allocation or balanced advantages funds, because there the fund manager is actually taking a decision. And some of these retail investors do not have the ability to hire a professional wealth management firm to advise them on their asset allocation needs. So they can actually go to ready-made solutions over there. But yes, HNIs, UHNIs who can afford to have an advisor over there, there my advice is do not get carried away with certain sectors. Just keep maybe a smaller portion, which could be 10 to 20% to certain satellite themes,
Yeah.
and then participate over there.
Okay, let's break it down though. And since you've mentioned defense a couple of times, I want to specifically ask you about that. There are a few more options that are available apart from the HDFC Defense Fund in the passive category as well. But considering the kind of run-up that you've seen in the defense pack as a whole, 20% plus last week, maybe some cool-off is seen this week, but would you take money off the table, tactically speaking, right now, if someone was to come to you, Himanshu, and say, look, I had this, I've been doing an SIP over the course of the last several months, and it's given me, what, 55%, shall we say, over the course of the last 1 year. And of course, that is point to point. You would probably have gotten more basis your SIP. Would you take money off the table?
So I will also take into consideration what is the capital gains tax which will be applicable, because if I'm paying short-term capital gains, it's also an added cost to me.
Yeah.
Is there any exit load which is applicable in case I take it out? I need to give weightage to those things because that's an actual cost which I'm paying over there. Ideally, I would like to be in the long-term capital gains tax regime, and I would like to be off the exit load period. Then it makes sense because clearly the valuations today in this sector are looking expensive. And since I have made very good returns, and if there is no adverse penalty I need to pay, maybe I would like to rebalance it over there.
But if the first 2 points that you raised in terms of short-term capital gains and exit load are not ticked, then you would say that incremental investments into the space might be stopped and you can hold. Is that a valid approach?
Absolutely. So in case there is an exit load as well as a short-term capital gains, I would like to hold on to whatever I have invested over there, provided I'm not overexposed to this one particular sector, which in most of the cases will be the case. And fresh investments, I will recommend not to go in for this because already the sector has run up quite a bit. And today it's an expensive sector to buy.
Okay. Just on the point of exit loads, you pointed that out, and for most people would know about this, but for the few of you that are coming across the theme for the first time, what happens is that a few fund managers, fund houses rather, actually put a load on selling of the units in a mutual fund scheme, and this is to incentivize you or to stay longer, rather disincentivize you from selling too early. Himanshu, is that a fair assessment?
I would say there are merits and demerits. Merit is if someone is coming in a scheme, they need to have a certain minimum time horizon. Because otherwise, if there is no exit or entry load, people can become more traders. So the whole thought of lock-ins or having an exit penalty is you come in as an investor, which is with a certain long-term view over there. While yes, if there is a penalty, maybe the fund house makes more money at the cost of the investor. So that's a disadvantage to the investor. But to me, it sounds more like protecting the interest of the investor and getting the right kind of an investor with the right kind of a time frame to come into those schemes.
Yeah, and there are some very prominent names that have a pretty long a period for which they choose to have an exit load, and you know, the likes of the largest mutual fund scheme in India also has a pretty long period. But let's talk about a few of these other themes, Himanshu. And if you were talking about tactical allocations, and you mentioned banking and financial services, I do want to ask you about that specifically, because the way that I see it, most diversified funds, or even something like a Nifty 50, Nifty Next 50, would have a sizable allocation to banking and financial services, just purely by dint of the fact that these companies have a pretty large weightage. So why would you want to go and have a further satellite allocation?
Right. So let's say if an index gives me 30% exposure towards these, and today I feel this sector is slightly undervalued with maybe attractive valuations. And if let's say FPI inflow starts coming in, which has just started happening also, uh, and with interest rates the way they are, and there could be a likely rate cuts which could happen. Now, maybe the sector I'm expecting it to outperform. So then I would rather be maybe 35 to 40% rather than 30%, which let's say a diversified fund is giving it to me. So I want to be overweight over there. And one of the ways over there is, since if I'm positive over there, to take maybe a particular sectoral call over there and go for a pure sectoral fund over there or an index over there. Because there are certain tailwinds which are fairly strong over there in this particular sector. So idea is always how much you want to be over and above what the benchmarks are offering you. And if you want to, you're bullish on a sector, there is actually no other way other than to go for a pure sectoral fund.
Okay. I want to delve into each of the sectors that I've selected. And I've selected pretty much the biggest sectors where there's most population of schemes. Consumption is the next one I want to talk to you about, because everyone's talked about consumption over the last few months, not FMCG, but consumption. And from that perspective, a lot of people have also started investing in this, thinking that at some point there's going to be this whole bonanza in the way of the income tax breaks that will come through April onwards, and these companies will start reporting better numbers. There's going to be returns through the roof. How have you looked at it, and are you advising your clients to look at consumption theme?
So consumption is actually a big theme in India because uh, almost 85 to 90% we are dependent on Indian consumption. We are not too much into exports. So consumption is going to do fairly well from a long-term point of view. And right now, I feel the valuations are fair over there. If one has to go over there, maybe go through diversified funds and let the fund manager decide how much they want to put in the consumption and which category of consumption they want to put in over there. So I'm not advising any particular sectoral fund over there right now because it's not, I have a long-term positive view, but valuations are also fair. It's not undervalued over there.
Okay, so that consumption out of the way. Infrastructure. And here, Himanshu, I think a lot of people are positive because of the growth story in India. And ultimately, for India to grow, power infrastructure has to grow. But the reality is that you've seen significant underperformance by a few schemes in this category as well. How would you approach this, and would you advise looking at this tactically?
So I would say we are quite bullish on India, and infrastructure is something which will actually lead to India growth story over a long period of time. So if we see all the data, the road construction, the railways which is happening, infrastructure which is getting built up in the country, whether it is power, next few years, there will be a lot of action over here. So I would say, yes, I'm extremely bullish on infrastructure. Only thing is, going through infrastructure fund per se, if I want to pick up, let's say, 5 stocks over there, and because of a particular sectoral fund or because of a particular index which I choose, I get 40 companies over there. Maybe 5 of them are I'm very bullish on, but 20 of them I'm average, and maybe 15 just come in as a baggage over there. So there I'm saying, unless uh, you have the ability to pick up those 5 stocks, do it yourself, or maybe just go to a fund which may want to emphasize slightly more on infrastructure, but not a pure sectoral fund. That would be a right approach over there because I do not want to get the baggage of 15 stocks which will come as a part of my uh, pure infrastructure fund. I would like to just see if the fund manager can pick up the winners, or I have the ability through my own office to pick up the winners, pick up those stocks and hold on to it for a long-term period of time. So short-term tactical call, no. Long-term, I'm very, very bullish. Fundamentally, infrastructure is going to do very well in India.
Okay. Himanshu, there are few schemes in this category that are very old. And I'm not asking you to necessarily recommend any, but I'm sure that you've studied the portfolios, for example, DSP India Tiger. And
Right.
I looked at the last 1 year performance, and I've looked at the fact that it's down 0.84%. But since inception, it's what, 17.7% CAGR, and it's significantly beaten the benchmark, right? So what explains the underperformance? You have Tata Infra also that is relatively underperformed, Quant Infra is underperformed, whereas on the other end you have an outperformance by something like an LIC Infra, which is a positive 8.8. So there's a pretty big divergence here.
Right. So it also depends on which stocks they have selected, how much overweight they have gone on a particular stock. So if you ask me, there will be always a short-term divergence, but long-term they should actually move more towards the mean part of it. Uh, but over here, Alex, I would say infrastructure Tiger Fund, for example, has given phenomenally good returns over last 20 years. Over last 20 years, it has done fairly well. But last 1 year, the theme of value has come down. Growth has actually picked up over here. And some of these value stocks have not done very well in the recent past. But if I just take out last 6 to 12 months and before that, 3 years previous to this, value was doing very well. And that's where infrastructure or some of the PSUs, they were actually outperforming a lot. But a time for growth has actually come in for last 8, 9 months. And that is where maybe you have seen a negative return in some of these infrastructure oblique value themes in the last few months or so.
Okay, let's round off the list and talk about pharma, healthcare, and technology. And would you advise getting in tactically to any one of these, considering the kind of news flow that is coming in from the United States, and that's having a bearing on these practically on a daily basis, Himanshu?
Right. So very interesting point, Alex. Now, something which is not doing very well and has fallen. Typically, the tendency is to move away from there. I would say IT and pharma, healthcare, they are great long-term themes. And if it has fallen, maybe it's the time to become slightly greedy over there. And yes, there could be more news flows which could come. There could be higher volatility in these sectors as we see. Maybe if someone has to pick up, where valuations may suggest that you pick it up, but maybe go in a systematic manner. Don't buy it on day one. Maybe spread it over next 3 to 12 months, depending on your profile, whether you're aggressive, moderate, or conservative.
Okay. Now, to bring this conversation home, just a point. You've spoken about satellite allocation of 10 to 20%. Now,
Right.
how would you approach this? Because you see opportunities in sectors in particular. It's like you have stocks. When you have dry gunpowder, you will deploy at once. So there is a lump sum investment, and you've pointed out in certain sectors you can stagger your investment. Is an SIP approach appropriate here, or would you tactically shift out of certain things and shift into a sectoral thematic fund?
So let's say 80% is more like a core portfolio.
Yes.
There, Alex, we believe one should just enter and hold on to it for about, let's say, 5 years, because equity is actually a 5 year kind of a time horizon is required. Even if exit load moves away after 1 year, your long-term capital gain tax kicks in after 1 year, but you hold on to your core portfolio with a 5 year view. Satellite portfolio could be with a 1 to 2 years view, minimum 1 year because of the taxation and loads which are applicable up to 1 year, adverse taxation and loads which are applicable up to 1 year. So there I would say certain themes where I am seeing certain volatility. Let's say uh, I mentioned to you about IT or healthcare because of tariffs or because of whatever is happening in US right now. A lot of it is happening. Volatility is happening because of that. It's likely to continue for some more time. So there it's more prudent to do systematic investment plan, SIPs. Now, I know there could be an opportunity today, but I want to reduce the risk also because everyone focus on one R, which is return, but second R, which is risk, is equally important or even more important. There, I would say if someone is extremely bullish, maybe do a shorter term, 3 months SIP, but don't go lump sum over there. Also, when you are have to move this, you have to see from where you can pull it out. Is it fresh savings which you are getting from your monthly salaries? Maybe use that. If not, maybe some money is lying in liquid funds, use that. Or maybe some places where you have actually completed a 5 years period and there is a reasonable returns over there, and you want to take advantage, maybe redeem that and invest over here.
Okay. Himanshu, the last point, and I'm not pushing you to make recommendations, but we've spoken about BFSI, we've spoken about healthcare, and we've spoken about IT. And these are three themes that you seem to like at this juncture based on everything that is happening. Specifically, from the list of schemes that are available, what schemes, according to you, are well run and that have a good track record that my viewers can look at closely?
So I would say, Alex, rather than recommending you any particular schemes,
Yes.
I will say there are certain fund houses which are very well run. Whether it is HDFC, whether it is ICI, whether it is Nippon, some of these fund houses, they are run very, very well. If you are going in for the thematic schemes, I would emphasize that maybe go for the index funds over there. Or maybe if you are to still want to go for an active manager in these themes, pick up from one of these good houses where you are very sure about the long-term duration, maybe the governance systems, credibility has been established. So I would recommend maybe going for good houses. And again, as the data I have shared with you, I see a lot of merit in going through pure index funds rather than active managers for these thematic schemes.
Yeah, very, very well put, because active managers have failed to beat the benchmark over a period of time. Himanshu, thanks so much for joining me today. Pleasure having you on the show.
Thank you so much. Thank you, Alex.
All right, that brings us to the end of this edition of Your Money Matters. It's possible that you're left with a few questions after this conversation that we've had, even though it's been pretty detailed. But I'd invite you to write to us in the comment section and let us know what you'd like to know about, and we'll take it up in future shows. Thanks so much for watching. This is NDTV Profit.